And joining me now is Robin Mills from Qamar Energy. Robin, thank you for taking the time and coming on the show. There's a growing dislocation between physical and paper oil markets. That was the message by the Saudi energy minister last week. Give our viewers, please, a quick explanation how these markets are different and what effects could such a dislocation have on volatility, liquidity, and the oil and gas industry in general.
Sure. Well, of course, physical oil is real oil that's bought and sold in a market, and that includes many different grades of oil, different qualities, different times and locations. The financial oil is a different situation. That is oil that is being so-called paper barrels that are being traded in places like New York and London, and that includes oil that is being traded for delivery in a few months' time or even in years' time. Now, normally for the current for the prompt month, so the current month, those prices would align. I mean, the price of a paper barrel would be pretty much the same as the price of the real barrel. Prince Abdulaziz, the Saudi oil energy minister, was complaining that these two markets had got out of line, and I think really pointing to the fact that the paper market looked relatively weak, while he felt the physical market, which is what Saudi Aramco, the national oil companies, of course, sees, is still quite strong. And he was blaming speculation and geopolitical factors and so on for these two markets, in his view, getting out of line. And one of the problems here he saw was just lack of liquidity for the traders. So the energy market has been so volatile and so hard to trade that there's insufficient liquidity, he thought, in the paper market, and so that market is not really reflective of the fundamentals in his view.
In light of these comments, Robin, is there a new Saudi position being presented here? What does that mean for future OPEC Plus production levels?
Yes, there were two new things, I think, that came out of Prince Abdulaziz's comments. The first one was the possibility that OPEC could cut production again. So they've been basically increasing production for many months now, every month, and are getting to the point which their cuts have almost been wound up. He was putting forward the possibility they could cut production again if necessary because of these uncertainties, and really, of course, because oil prices have dropped quite significantly down to at some point to around $90 per barrel. And the other important thing that he put forward was the idea of a new OPEC Plus production agreement from 2023 onwards. So everyone's been asking, okay, the current deal in principle expires at the end of this year. Will there be a new deal? And his message in this was, yeah, that they're working on it and there will be some kind of a new deal.
What do you think is contributing to the market tightness at the moment? Is it upstream limited spare capacity or the refining bottlenecks?
Well, the crude oil market, I'd say, is not particularly tight at the moment. I mean, prices have fallen quite a bit, as we said. They were at $130 a barrel briefly earlier this year. Now they're fallen to $90 per barrel, although they've come back a bit in recent days. What we have to look forward to is what happens to the market towards the end of the year, when, first of all, the EU sanctions on Russia come into effect. That will mean 90% of Russian oil supplies to Europe will be banned. That oil will either have to go somewhere else, or it will simply can't be produced and can't be sold, and that will certainly tighten the market. And then the other side is the end of the release of the US strategic stock. So the US has been releasing about 1 million barrels per day of its strategic reserves. By October, it will finish that program, and it can't release much more without emptying the reserve. So it'll have to stop the release and perhaps even start buying back oil to refill the reserve. That, of course, will tighten the market as well. The refining market for refined oil products like petrol, gasoline and diesel and so on, that has been very tight. And so we were seeing huge margins for refiners, and we were seeing that even though crude oil was not too expensive, the end user price for fuels at the pump was very expensive. That has eased off a bit again in recent months, but again, if we look forward to the end of this year, it will be in the winter season. People need to heat their homes. Gas is very expensive. Some of them will use oil instead, and we could see the diesel market getting very tight and fuel prices going very high again.
We will discuss the sanctions on Russia in a bit, but let's talk about the Iran's potential return to oil markets. It is gaining ground as nuclear talks seem to be progressing, but there still is a debate about the speed and the size of such an Iranian return. How do you see this playing out?
Well, firstly, will there be a deal? I mean, we've been round the, round the negotiations of this deal for so long now, and there have been so many times. Like early this year, we thought, yes, we're almost at a breakthrough. Deal will be very soon. Then it broke down again. Okay, but let's say there is a deal. I mean, the signs recently have been fairly positive. If there is a deal, then I expect that Iranian production will come back to the market pretty quickly. The fields have been shut down in an orderly way, that they're not damaged. And the Iranians have done this before. Of course, they did this back in 2016 when the last nuclear deal was agreed. They also have a lot of oil in storage. They probably have 100 million barrels or so in storage, in tankers and so on, between oil and other products that they can bring back to market almost immediately. So it'll just be a few months for them in terms of getting back to their customers, going back to India and Japan and South Korea and some of their other past major customers, and re-establishing those relationships and starting sales again. So I expect Iran to add 1 million barrels per day or 1.2 million of production and exports within a few months following a deal.
Russia's exports still is the biggest wild card at the moment. You've mentioned EU-US potential price cap on Russian oil exports. These are being discussed in addition to shipping and insurance restrictions. Do you expect such sanctions to see the day of light without a consensus that includes the big oil importers in Asia in particular? And are they enforceable, really?
Well, this is going to be a super tricky situation. At the moment, the EU has a ban coming into effect on 5th of December on basically 90% of crude oil exports into Europe. And then 5th of February, there'll be a ban on refined product exports, so gasoline and diesel and so on, into Europe. That will have a huge impact, and Russia will have to look for markets elsewhere. The EU and the US, they're worried that actually bringing this ban into effect might take a lot of Russian oil off the market and lead to prices spiking again. So they're looking at this alternative to say, well, let's put a price cap on Russian oil, and let's say you can only sell at a certain price, which would be something close to, hopefully close to the Russian company's production costs, plus a small margin. And then if you're trying to sell it above that cap, you would have a ban on insurance and shipping and so on, which would make it impossible for you to sell that oil. Now, the proposition, I think, to Asian countries, and particularly, let's say, India, is, well, if you join this price cap, you'll be able to get cheap Russian oil as well, and we won't be taking oil off the market, so the prices hopefully won't go too high. And so this is a good deal for everybody, of course, except Russia. Will India and other Asian countries go for this? You know, the US hope, I think, is to bring more and more countries into the price cap, and of course, the more that sign up for it, the more effective it will be. There's no enforcement unless the US wants to get very aggressive, and the US and the EU want to get very aggressive on going after shipping and insurance and trying to make it very difficult to move this oil around. And that would create big tensions with some of their allies in Asia. So it is a difficult situation. It's not easy unless I think there's a change of heart on the part of the Indian government in particular.
Talking about difficult positions, maybe the U.S. administration is finding itself in one. It's asking U.S. refiners to limit fuel exports at a time where U.S. exports of crude and products have reached a new all-time high of 11 million barrels per day. Can this effort achieve a lower price at the pump for Americans? And how would European allies view such a step?
Yeah, I mean, I think these suggestions are completely crazy, and I can't think what the administration is doing in terms of trying to have a joined-up policy on this. I mean, firstly, the US imports some crude oil, it exports crude oil, it imports some products, it exports others, because the US is a very complicated place with a lot of different markets and a lot of different needs, and it's very well integrated to the global oil system. Trying to cut it out of that, trying to limit exports will disrupt a lot of the oil system, will drive up prices for everybody and make the whole system much less efficient for a start. The refiners and US oil traders will export oil if they see a market opportunity, unless the government actually wants to put a ban on this, which will certainly be very, very disruptive. And this would be a real sign to the Europeans that you're on your own against Russia. You are not going to get fuel from the US, and the US is a very important exporter of fuel, refined fuel to Europe, and will be particularly over the winter when as we discussed, Europe potentially will be short of some fuels.
Robin, given the energy crisis faced by the world today, do you get a sense that the debate on energy transition is changing vis-a-vis the big oil companies who all seem to be back at exploration nowadays?
This goes both ways. Prices are high, particularly gas prices, but oil prices are pretty good too. The big oil companies, the pressure is off them, at least temporarily, and they are seeing some very good exploration opportunities around the world. We've seen great success in Guyana, for example, in Namibia, in new frontier areas in other parts of the world, and development of existing well-established areas. So for now, the pressure, I think, is off temporarily because governments, even European governments, say, yes, we're getting off oil and gas, but for the short term, we need more to replace Russia. I think in the longer term, though, this gives a big push to the alternative energy because it's become very, very clear that, okay, it's not good to be too reliant on oil and gas only. It's certainly not good to be too reliant on only one supplier. And so over the next few years, we will see a huge push within Europe and the US to boost the use of renewable energy for one, but also the use of electric vehicles, and so reducing the amount of oil that's required. So in the longer term, this is going to give a big push for these alternative energy sources.
Robin Mills from Qamar Energy, thank you so much for taking the time and being on the show.
Thank you.